Now the mic is on. My apologies. I think I am retrogressing in my technical abilities rather than moving forward. Since no one heard me up until now, this is Joseph Trevisani from FX Solutions. I apologize for the delay. My computer blew up last week. I had been speaking, yes, but I will repeat all of it. And it was only technical and greetings. I forgot to turn the mic on. So anyway, my computer blew up last week. I had to have new systems installed. I forgot to put Hotcom on. So again, my apologies for the delay. What you're looking at now is the 10-year or a 10-year. It's not the generic. The 10-year in the Greek bond, the Greek 10-year, sort of the benchmark that everyone uses against the German Bund. There is a lot of happiness in this chart for Ben Bernanke and the Fed. But why that is true, we will get to that in a minute. First of all, let's bring up the Euro chart. And where's the Euro chart? Here's the Euro chart. So this is the daily Euro chart. From the bottom in June till now. The Fed first announced, or at least hinted at, their QE policy, what they would do with the weakness in the economy. Can everyone see the chart? There should just be a regular chart of the euro up. The Fed announced they didn't actually announce it. Interestingly enough, the Fed is about to embark on a policy which has not really done much good in its first incarnation, yet the Fed seems determined to keep on this path. And there are a couple of questions we have to ask. Why would the Fed do this if it didn't work the last time? What is their purpose? Do they not understand the ramifications of this policy? Do they not understand the potential resistance and the potential risks? Of course, the answer to all of those questions is absolutely they do. The Fed is not doing this. Mr. Bernanke and the board is not doing this unknowingly. They know what the risks are. They know that there's a strong risk the dollar will devalue mightily based on this program. But a little bit of history. In the last but one FOMC meeting, the Fed changed the language to say that they would take additional appropriate measures if necessary. Very small phrase, additional appropriate measures, and really, the real key to that, of course, was additional. Well, something else. The entire market, everybody listening from top to bottom, took that to mean, correctly so, more QE. So that was September 21st. This is September 21st, right here. That long line up is September 21st. What does it look like? It looks a lot like March 18th, 2009, right there. Same deal. That day was when the Fed announced, that was a little more than a year and a half ago now, a little bit more, when the Fed announced their first QE policy, the one of $175 trillion, with 145 in the MBS market and 300 million in the Treasury market. Yes, okay. I'll turn up the mic as well a little bit. Same reaction. Much smaller, of course, because this announcement was not a surprise. Not really, because there had been much speculation on that the Fed would do this, and there was no size. So all the Fed did was hint very strongly that they were going to do QE, but we got the same type of reaction. The markets hate QE. Currency markets, at least the dollar, hates QE. This is not news to the Fed, the FOMC board, or anybody else, or any currency trader. As soon as they announced that if you were trading, you should have gone long. Should have been patient, but you should have gone long. This is the type of event, the type of program that gives you long-term FX trends. Let us look at the trend from March 18th. Yes, it went up and then it came down to the bottom, pretty much where it started, but then you had this long rise in the dollar. In the euro, and fall in the dollar. Same this time, although a much steeper rise if you look at it. This was rather prolonged from here to here. You had from, even if you take the bottom here, from May, it also rose a little bit further, but you went from about 129 or so, 128.73, up to 150. And then you had this rise, which was really from about 130 to about 1. So if you had 128 to 150, that's 22 big figures. This was actually 12 big figures. So it's not as long or a rise, but it is steeper. So the question we're going to have to look at is, the Fed is promising this. Once the Fed promised this, and I considered it a promise, I wrote about it. This is what I wrote in the middle of October. And this was after, and one of the things that the Fed did is they didn't just do this and forget about it. They then came out in speech and in presentation and in testimony, both by Ben Bernanke and several of the board members. They reinforced the idea quite a few times that this is what they were going to do if they think it's warranted. Well, that if they think it's warranted was kind of unnecessary, because if they didn't think if it was warranted, they wouldn't have announced it in the first place. So the announcement already presumes the fact that it is necessary. Otherwise, why bring it up? So clearly the Fed was telling everyone, hey, this is where we're going. Now, the Bernanke Fed has been very different than the Greenspan Fed. The Greenspan Fed was the cryptic Fed. You all know my favorite quote from Alan Greenspan: if you have understood clearly what I have said, I must have misspoken. That is the way Mr. Greenspan liked to keep the markets basically in his back pocket until he decided to act. Mr. Bernanke runs a very different Fed. He prefers to have the markets well aware beforehand of his intention. The one positive from this, one certain positive from this, is you don't get violent moves, well, too much, in response to changes in Fed policy. The reason there was such a violent move back here on the 18th is because it was a complete surprise. The Fed hadn't done this in years and years and years, so it was a complete surprise. In general, Mr. Bernanke prefers to let the markets know, to telegraph it a long time ahead of time, then reinforce it so the markets will adjust on their own, an adjustment that won't be quite as rapid or as brutal, because after all, one of the things that the central bankers are always decrying is unnecessary, unhealthy volatility. Unless, of course, it's volatility that is the kind of volatility that they want. A good example of that is March 18th last year. The Fed was deliberately trying to shock some confidence back into the markets that the Fed would not let things collapse if it could have anything to do with it. That was a deliberate surprise. This time, the deliberation is to let the markets know and adjust on their own. So what Mr. Bernanke said 3 weeks after the original announcement on September 21st, or the original promise in the FOMC, in a speech in Boston, he said there would appear to be, all else being equal, to be a case for further action. He was deliberately reinforcing the idea that the Fed would act. The markets responded accordingly. If the Fed is going to be devaluing the dollar, and I don't know any other way to interpret this except that it's going to be devaluing the dollar. And remember, the Fed knows the results of its actions. It is not acting in a policy vacuum. It may have two goals, or its two mandates in the United States to manage inflation and to promote full employment, are not necessarily in agreement with the international result in the currency markets of its policies. But the Fed knows this. So there's no surprise that the dollar has taken off on the downside. It is my contention that given its two policy mandates and the pending election, the idea that the Fed, remember the pending election back in September, the idea that the Fed is apolitical is foolish. They operate in a totally political environment. They are one of the custodians of the American economy. The idea that they cannot take potential political results into their calculations is silly. They, of course, are. It looks to me that the Fed's announcement in September was politically motivated. Politically in the sense that the Fed did not like developments in the economy. The results of 2 years of administration policy has been a stagnant economy. You can make your arguments about whether it would have been worse. You can have your political discussions back and forth across the aisle in D.C., but the clear facts are unmistakable. It has not reduced employment. It has not generated housing sales. It has not really done very much at all. You had a sugar high in the fourth quarter of 2009, and the economy has been declining or moribund since then. You are not going to get jobs from a 2% growth economy, not the type of jobs or not the number of jobs that are necessary to bring down unemployment. Without employment, even back in September, if you were going to make a bet on the results of the election, I'll answer that question in a minute. Just give me a second. The bet you would make, and I think the bet that the Fed made. In fact, I took the Fed's QE announcement in September as a very serious sign that the Republicans were going to do extremely well in the election. It seemed to me that was one of the motivating forces for the FOMC. The government's policies, whatever you want to say about them, and I am not passing judgment on them, I'm trying to look just at the facts, have not succeeded by their own terms. It's that simple. The economy has weakened. Jobs have not been created. Housing prices are either flat or declining again. You are not going to get a recovery in. I'm looking at a report on CNBC right now from Zillow, the pricing website for homes across the country, and I've used them actually. They're pretty accurate. That negative equity increased 2.3%. I believe the month was in October. That is certainly going the wrong way, and you do have prices again beginning to decline in the housing market. That is one of the Fed's goals. I think the Fed. So back to the election or the pending election. It looks to me that the Fed was looking at what you're going to get, and even if they didn't make this, they're betting the odds on it. They are looking to do things that will prevent rather than create. Because I don't think the Fed expects, or anyone else expects, that QE will create jobs. The problem with credit availability in most cases in the U.S. right now is not a lack of credit availability. Although the banks have tightened up their standards, as they should have, since they were extremely lax throughout the housing bubble. The problem, both on the mortgage side and on the small business side, is lack of demand. If we've seen anything, we've had a year and a half of interest rates at historic or close to historic lows. Has there been a revival in the housing market? There has not. The reason is very simple. People don't use or as a friend of mine once said, you can't market time the purchase of your house to catch the bottom. People don't primarily make their housing purchase decision based on interest rates. They base it on their own economic status, on their view of the future, and on whether they feel comfortable signing up for 20 or 30 years of mortgage payments. And, of course, that they have the need. But remember, the need, family formation, the human factors behind housing purchases, have they changed over the past 3 years? Not very much. In fact, very, very little. People still get married. They still have children. They still do all of the things that lead to what the economists call household formation. But those things are no longer, not currently generating the type of household formation because of the economic situation, because of jobs. So interest rates are marginal factors, or at the margins they affect home purchases. They do not create demand. Now the Fed knows this. I'm looking at a report on the screen here in my office of protests in England over some of the austerity cuts in the universities of the Cameron government. That we're going to talk about in a little bit, and this is for Mr. Bernanke, a stroke of good luck. But we'll talk about that in a minute. So the Fed's QE policy is aimed at two things, but it is not really aimed, nor is it expected to by the Fed, to make everything hunky-dory in the economy. It is a defensive measure. It's defensive economically, and I think it's defensive politically. Economically, because the Fed feels that it could potentially be a good deal worse if it do that. And if it isn't a good deal worse, at least domestically, it won't do much harm. And in this, I agree with. One thing we should recall about the initial QE policy, $1.75 trillion. The trillions just trip off the tongue these days, don't they? Was that it was widely criticized at the time as to being the first step to rampant inflation. And the Fed and Mr. Bernanke's point was that without demand, there cannot be inflation. And Mr. Bernanke has been correct about that. $1.75 trillion in QE starting a year and a half ago has not even prevented disinflation. Inflation has fallen since then. It was over 2%. I actually have the figures here. It was, where are they? The Fed's target rate is supposedly between about 1.7 and 2%. In September, it went down to 8%. The lowest in 45 years. This is the core inflation number. After being 5 months at 0.9%. That's this year. It's only been lowered twice since this series has been kept. In 1961, February and March 1961. That would be right after JFK assumed the presidency. It was at 0.7 for 2 months. So $1.75 trillion in QE did not even prevent deflation. So there's a very good chance that the Fed is right, that unless you get a recovery in the economy, $600 billion is not going to sponsor inflation either. So the Fed has been right about that. For the two goals that the Fed is at, inflation and interest rates, what will be the result of QE? And in this, I think the Fed actually, one, can have an effect, although I don't think it will have anything more than an interest rate effect. The Fed can certainly. Now, one interesting thing about the Fed can certainly drive down the 10-year rates or whatever rates it chooses when it buys in that time frame. Curiously enough, the credit markets do not seem to be convinced that this is going to be a successful program even on the interest rate side. because since this announcement, 10-year rates have actually gone up a bit. Not a lot, but they've gone up a bit. Still, I think that when the Fed gets into the market and starts buying, it will be able to drive the rates down. We have actually the 10-year up to about 2.66, which is up from about 2.53 since the Fed has made that announcement. So that's not a particularly effective result. Still, though, I feel that the Fed will be able to do that. But as we've observed, lower rates do not create home sales. Jobs create home sales. So the Fed is not going to be successful, really, in sponsoring a revival in the home sector. I don't think it plans to. I don't think it expects to. I think it's a backstop. The other thing that the Fed can affect, and I think wants to affect, is inflation. But the Fed is not interested this time in controlling inflation, which is sort of the historical role of the Fed, because we've always had inflation, except for Japan. We've always had inflation in the modern era. The Fed wants to bring inflation back somewhat to the U.S. economy. It would probably like to have another point of inflation. If we're running on the core rate at 0.8, after having been 5 months at 0.9, and the Fed's preferred rate is somewhere between 1.5% and 2%, this is something the Fed can do. And the Fed does it through the dollar. Because even though there's not enough demand in the United States to give firms pricing power, firms will, because they're all affected similarly, and because the petroleum products that are one of the primary mechanisms of this enter directly into the consumer price structure in the United States. Oil was back above $87. Many other commodity prices, including gold, are rising. Gold hit another record yesterday, over $1,400. This is a direct effect of the Fed's policy. It is also, I feel, the intention of the Fed's policy. The Fed wants to bring inflation back to a higher level in the U.S. because it fears deflation and because it fears disinflation. And this is one thing that it can do. I'm buying gas here in New Jersey, which has relatively low taxes on gas, and it's over $3 a gallon again for premium. It's about $2.60 or $2.70 for regular. This is up 30 or 40 cents from 6 months ago. So the Fed is deliberately fostering inflation back into the U.S. through its weak dollar policy. Now, the Fed, of course, or at least Mr. Geithner, has said at least once over the past few weeks that the government has a strong dollar policy. Well, that is the only thing the government ever says, and so the fact that they say it doesn't really mean very much. Markets are going to pay a great deal of more attention to the actuality of what they're doing than it is to their words. You also have a number of statements by the President Barack Obama, that he wants to increase exports. Okay. Well, if you're looking at a time frame of anything less than 5 years, which say would take the time to form a new high-tech company and get a product up and running, you're talking about mercantilist policies based on exchange rates. So if you have Mr. Bernanke, actually President Obama was first, you have President Obama saying that he wants to increase American exports. You have Mr. Bernanke selling trillions or buying trillions of treasury debt. Then you'll have to forgive everyone in other central banks and other governments and in the currency markets, but thinking that, it seems to me that the U.S. has an official weak dollar policy and that it is backing it up with actions in the markets. Two things are an issue here. Three things actually. One, the U.S. is the reserve currency. When it makes policy decisions like this, the ramifications are vast. 2, everyone, to a greater or lesser degree, is concerned about their economy. Everyone would like to export more. And 3, there will be reactions from other governments. I don't think we're going to get the type of trade barriers and obvious tariffs that you saw in the 30s, which did so much to exacerbate the depression, or the recession at the time into a depression. But the idea that other countries who are also concerned about their domestic economy, whose responsibilities of the government and the banks, the central banks, is to their domestic economy, is going to look at this and say, okay, we acquiesce. The U.S. has an enormous deficit. It doesn't want to deal with it internally. What are the British and the Germans going to say to this? Since their way to handle this is to cut spending and reduce the deficit. Ours is to expect other people to fund it. And that is an inescapable conclusion from the administration's policy and from the Fed policy. There has been, and I think there will continue to be, enormous pushback about this around the world. So, one other thing. Let us examine what has happened so far since that announcement. Let me just answer this question here. That's true. The QE does not seem to do any good, and I agree with that. If we want, and we've talked about this in the past at past webinars, if you want an example of the futility of QE policy and Keynesian spending in an economy that is not in a cyclical business recession, then look at Japan. There's no better example of endless government spending, of endless money flooded out into the economy from the government. Japan's debt, national debt, is around 200% of GDP. Ours is approaching, I think, 60, and it's headed towards 90 by the end of the projections in 10 years from the current and from the administration. It hasn't affected Japan's currency as much for all sorts of reasons, one of which most of the debt is held domestically. But it has unmistakably done nothing to promote the health of the Japanese economy, because the issues are not the availability of credit. The issues are demand. And domestic demand in Japan has not been swayed 2 iotas, maybe 1, but not 2, by these government policies. Japan has been unable to export its way out of it. Certainly the valuable yen has not helped. But the government policies themselves do not work. They have not created domestic demand, which is what they need to do. You aren't going to get domestic demand created from the QE policies in the United States as well. We don't have to look to Japan, although I like to, because there's such a long 15-year history of the failure of these policies in Japan. You can look at the past year and a half, where we've had a QE policy in the United States, a very large QE policy, and it has most clearly not prompted a healthy economy, and I don't think it can. These are different issues. Okay, so we have the QE policy running up the euro and the other currencies, running down the dollar, and suddenly we get this big stall right here. Now, the markets were undecided when this policy first was announced back in February, how much would actually be used. The speculation was from probably about 500 billion, maybe 300 billion, all the way up to several trillions. But there was no real hints coming out of the Fed as to what they would get. The $600 billion. Now, the initial speculation I thought was pretty wide of the mark. Sort of settled down in most commentators to between $500 billion and $1 trillion. So the Fed kept to the low side of that initial as far as new money goes, having previously announced that they would reinvest all of the maturing MBS and Treasury purchases from the first QE policy. That was 300. The Treasuries, excuse me, that was 300. So you ended up somewhere around 900, so somewhere around $1 trillion. There's so much leeway in these numbers. One thing to be interesting to see if the new Republicans in the House can actually get the Fed to open up its books so we can see what's going on there. The Fed, of course, is very much against that, but it will be interesting to see if they can pressure that so the government and the legislature can actually see what the Fed is doing and what they're up to, what's on their books. So we had $1 trillion, approximately, announced really this past November 3rd, which is right here on the chart, and that was pretty much the peak on the 4th when it went up to 142. What do we got here? 142.80 the day after the announcement, and it kind of has come back all the way to 37. The figure, Mr. Bernanke's luck. Because what would have been the result? Now he knew this, and the FOMC knows that what caused this turn right here, and that's a very easy thing to show you, and I will. And this is why I call it Mr. Bernanke's luck. This is it. What date is this right here? This is the Greek. I'm using Greece as the poster child for this, but I'll look at Ireland in a second. This is 10/13. From about October 13th to say October 18th, we have this the rise again of the enormous concern for European sovereign debt. When the EU and everyone else, let me refresh the cam. My apologies. Sorry, folks. Okay, there we go. Got it. This is Greek sovereign debt. So this bottom right here is 10/13. Look at Irish sovereign debt. That's not a pretty picture. These are the 10-year yields. Whoa! Forgive me. I think I'm spending a lot of time with my kids and they do things like that. Record. This is the April and the peak back here in early May before the EU announcement. That was around 5-6%. We're now at over 8.5% in Irish debt. Seems clear. Now, you know what's happening here, though, is the Greeks were up against a redemption deadline. That's what prompted this settlement. The Greeks did not have the money to redeem bonds that were coming due. Had they not gotten the money, they would have had to default. There isn't any choice. What's happening here is not the same. There isn't an immediate deadline for the redemption of Irish debt. It's just that the market is no longer valuing it and demanding much higher return. Let's look at some of the others. So Ireland isn't under the immediate gun to borrow money from the EU to take care of their debt because it's not coming due at the moment. So here's the yield graph. Portugal, same thing, well over where it was in May. Let's look at some of these other poster children for this. Spain, again, where's this is the daily. Spain is not going to give us, unfortunately, the information we want. Bloomberg can be a bit odd sometimes. You don't always get uniform results from the same inquiries. And this is a daily chart. But as you can see, they're all rising. Let's look at the German. And I think we know what's going to be on with the German chart. Down from the peak, but also rising a bit as well. Nothing very serious there, though. So the Greek debt, let's look at the Irish debt. Let's look at the turnaround in the Irish debt and take that point. Okay, the turnaround right here was 10/18. Now let's look at when the euro stalled. I'll switch the camera back. Now we're back on the euro chart. 1018. And where are we right here? This is around 10.6. So I would say that all of this consolidation, Bernanke's luck, is due to a problem in Euroland, not to, okay, we should have the euro chart up. I put it back. So this consolidation right here does not at all relate to the policies of the Fed. The Fed got lucky, because it's my guess that if you're a trader or anyone else and you're looking at what the Fed is about to do, and the Fed seems determined to do this, would you be buying dollars? Would any of us be buying dollars? No. But the Europeans, God bless them, are helping out the Fed because their credit problems, which were never solved, are back on the front burner. And so the Fed is not paying the penalty publicly for the problems that it's creating in the world financial system. It seems to me that the Fed is tilting a bit at economic windmills, in the old Spanish Don Quixote phrase. If what they're going to do is going to have very little effect on the U.S. economy, and I don't think it will, then what exactly is the point of this policy? If we look at U.S. statistics over the past month, including the initial jobless claims today, they were down again 25,000 after being up 27, down to about 435 if I remember. And other numbers out of the U.S. economy are slowly beginning to recover. I think that you're getting better numbers because the election from about at least a month ago seemed pretty clear that it was headed towards a Republican victory. Regardless of policy, a Republican victory in opposition to the activist policies of the Obama administration is something that most businessmen in the United States would favor. So you were looking at least, if not an actual recovery in hiring, a recovery in attitudes, because there's not going to be any more policies out of D.C. You're certainly not going to get cap and trade and any of the other policies that were loaded onto the business community here in the United States, and absolutely were a detriment to the formation of jobs and businesses. So that recovery in attitudes, which has not translated really into recovery in employment, although we did get a better number for October, is not the recovery perhaps that the Fed was looking at back in late August and early September when it formulated its analysis of the U.S. economy leading into the FOMC statement on September 21st. So that is not an active policy that seems to be tilting at an active problem. It's insurance, and I understand the Fed likes to take out insurance because in its view, the catastrophe or calamity that could occur potentially, whatever the odds, is so great that any amount of insurance is worth the risk. I do not agree with that, and I think the results internationally are very, very dangerous and long-term detrimental to the benefit to the interests of the United States. Why so? We've seen a round of objections from all of the U.S. trading partners, including China, at the G20, which is this weekend, about the currency policies of the U.S. You cannot both have the undoubted benefits of the world reserve currency, which are hugely to the benefit of the U.S. government, especially a deficit-mad U.S. government, and devalue your currency at the same time. The two do not work. And that is what the U.S. representatives are going to hear at the G20. It's not going to be in the public communique, unless, of course, we get two communiques, one from the U.S. and one from everybody else. I would certainly hope that that's not the case. But you cannot have an official devaluation policy and expect to retain the benefits of having the world reserve currency. It does not exist. And I think the government is being extremely, shall I put this, unaware that they're sponsoring this. Is Mr. Bernanke playing a double game here, knowing that if he announces a QE policy, it will devalue the dollar, and the devaluation in the dollar will be resented and resisted by everyone else around the world, and that pressure will perhaps feed back into the United States as a measure of influence on U.S. budget deficits, which Mr. Bernanke himself has said are unsustainable? I hesitate to make such a categorical judgment on policy, and I don't really think that's the case. But are they aware that all of these things are potential and in the mix? If we can talk about them, then they can talk about them. If we know them, if we speculate on them, then they will as well. And these views, I feel sure, have been represented in the FOMC meetings. They may not really be portrayed in their depth and perhaps acerbity in the minutes, but they have certainly been discussed at the FOMC board meetings. Remember, Mr. Bernanke, on his reappointment, had, I think, 30 senators vote against him. That is the highest number of senators that have ever voted against a reconfirmation of a Fed chairman. There is no consensus at the FOMC, in the U.S., in policy circles, or certainly internationally, that backs up this policy. The U.S., it appears, and appears to the rest of the world, and certainly in their rhetoric, is attempting to get the rest of the world to pay for the deficits and profligacy of the government. And this is not going to be successful. If you want to diminish and then eliminate a reserve currency, there is absolutely no better way to do it than an official devaluation policy, even if you don't call it that. I wrote an article, I don't know, last year, 2 years ago actually, for Forbes, Forbes.com, and it was about inflation and fiat currencies. And my point was that fiat currencies, which is what we all have, created currencies, why is the dollar worth it? Well, because we all believe it, and the government tells us so. It has no intrinsic value. However, it has an enormous efficiency quotient. It's very, very easy. Take out that dollar or that pound or that euro from your wallet and stare at it for a while. And then think about what it actually means and what it represents and why it represents that. It represents that because we all agree that it does. And it's to our benefit because it's so efficient. But the end of almost all currencies, and this has happened over and over and over and over again in history, is that the government that creates it runs out of money and begins to devalue the currency. The Romans used to debase their currency and many others by reducing the percentage of precious metals in the currencies, and it has happened over and over and over again. Currencies, fiat currency are the creation of governments, and they are almost always destroyed by countries as well, by governments, and always for the same reason. So I don't think that the U.S. can continue this policy and be successful. It is and appears to be a direct challenge to its own former role. I'll answer that question in a minute. To its own former role as world economic leader, and very much, certainly since the fall of the Soviet Union, world political leader. I think, and it appears to me, in some of the things that President Obama has said, that he does not think that this is a role that the U.S. should be playing. I'm not going to comment on that, but it seems to be playing out, that idea, in the economic realm as well. Question is, do you think the Fed needs economists versus what they have now? No. They probably do need economists because it seems to me that they have politicians. And I'm not sure that that's a particularly good idea. The Fed board is acting within a logical framework that it's interpreting, to my mind, far too widely. I mean, if you look, the U.S. has been accusing China of being a currency manipulator for how long? Well, the Chinese comment is going to be, what, us? What about you? Where are you going to carry a world opinion about the Chinese and about what they do with their currency, which they do manipulate, and so do many others? When the Fed, it appears, is announcing a QE policy that can only be interpreted as I'll answer that in a second. That can only be interpreted as a deliberate, both abnegation of its role as the custodian of the world currency and as an attempt to get the world to pay for U.S. deficits, which is not going to work. Not now. For the past generation, it has worked. But everything is now questioning, everything that's happened in the past 3 years has questioned both the primacy of the U.S., the financial system, and the U.S. economy. People always believed that the U.S. economy would recover, prosper, and grow. They are doubting that now, and you cannot combine that doubt with a deliberate devaluation policy on the part of the government. The two are not going to go work, and you are not going to maintain its role. Yes, I'm sure Mr. Obama has had an economic class because we went to the same school. And I know I had to have an economic class because it was required, and so I know that he did as well. That doesn't answer the question, though. We were actually there about at the same time, but I don't think I ever knew the man. Anyway, if there are no other questions, I've been running now about an hour, about 55 minutes. So I will not keep you. I know that they have another webinar pending, or they usually do anyway. It's usually Derek Fry. Yes, Columbia. You're asking. That's correct. Oh no, there is an economics requirement at Columbia. There was when I was there anyway. But I was there a while ago. In the 80s, in the early 80s. There is no webinar after this. Okay, are there any other questions? And are there any other topics related to this that anyone would like to cover? I have a few more things I can go through after this if you'd like. It is very interesting that this is one of the first times I have seen the amount of dissension. I cannot ask, I don't know. I did not know. I believe we were at Columbia at about the same time. I have never checked his attendance dates, so I don't know. I do not believe I ever met the man when he was an undergraduate, although perhaps we played basketball together in Riverside Park. But I don't know that for a fact either. Let me ask you another question here. Is the euro at the end of the year? Yes, Rick Santelli is absolutely correct. He's one of my favorite people on CNBC. I've never met the man. I would love to actually. He has one of the most consistent viewpoints on what is going on economically that I know of, and I think he's a great commentator. I really do. Where's the euro going to be at the end of the year? That's a very good question because I'm thinking about it. My guess, the euro is going to be somewhere around 132. And the reason I say that is because I don't think that the European debt problems are I mean, we're in the middle of November already, and it's only, a month and a half away. We have November and December. It's almost Thanksgiving and Christmas, folks. And the reason I say that is because I think this problem is going to get more widespread as the issue of the European sovereign debt continues. You are seeing protests, as I said, in Britain from the university students. Well, it's all right. Students like to protest. You saw all of the strikes and problems in France. And this was always the question with the austerity programs that are being forced through many of the EU countries. These are democracies. They can elect and unelect governments. They can protest. They are not going to be shot down in the streets as they might be in other places. All of this pressure brings serious questions to whether or not these austerity plans are going to work. Because in Greece and in many of the other countries, Germany's going to be reasonably okay because Germany exports Mercedes and everybody likes Mercedes and only Germany makes them. But Greece and Portugal, Spain, their export products are not price inelastic. They are price elastic. Or as the example I use in a webinar we held here for some of our customers, Greek wine is good, but so is Chilean wine. Product substitution. It's a little harder to substitute for a Mercedes. Yes, Lexus is good, but it's a little harder to. So Germany has an economy based on high-value products. The rim countries in the EU do not. And they are very much affected by a strong euro, whereas Germany is not so affected. So that is an issue which has never changed. In fact, the unitary currency makes it worse, makes it much worse. So all of this is in the background. Yes, back in May, the EU put in a program that prevented default by the Greeks. It has done nothing to address the long-term and sort of structural instability in the currency and more so in the political economic union of the EMU. They solved nothing by giving Rick Santelli, I'm just looking at Paul Volcker's note. He went off on that, the most criticism of the Fed ever. Yes, he is absolutely correct. And they are going to, they're not going to come out of the G20 with a acrimonious communique, but the blander that communique is, the more dissension is behind it at the EU. I mean, the other governments around the world have been quite upfront. Not so much our allies, or in Europe and Britain, but certainly in Asia and other places they have been very straightforward. I spoke to Reuters yesterday. There is a German rating agency, Dadong, that downgraded. It was set up by the government. It's more or less a government organ. Downgraded U.S. debt yesterday. Nobody, of course, paid any attention to it as far as the markets, but the logic is perfectly fine. That is not a place that the government really wants to go. You cannot, as I said, run enormous budget deficits, expect the world to fund them, and devalue your currency. It does not work. It beggars the mind that a government would have this as a policy. It does not work. Yes, you're absolutely correct about this. It is the good Lord, is that true? I'm looking at the comment on that the Greek bonds have the 900-point spread over the German bonds. And, this is going to get worse. And that's why I say the euro, I think, is going to go to 132. Because this gets worse as you get into the end of the year. Because all the liquidity starts to disappear. And so they're not going to get anyone helping out except maybe the EB ECB is going to go in there and start buying bonds. In fact, I think they were buying Irish bonds last week, although they're very coy about what's going on. So this entire issue of the European economies and the two-track EU is not going away. There is no way that the Greeks or other countries are going to be able to grow their economies enough to surmount their deficits and their fiscal needs under the pressure, very great pressure, of an expensive currency. They don't have the types of economies that can do this. There's only so far you can go with tourism. Only so much wine. I shouldn't keep returning to the wine metaphor, I think, so I'm going to have to let that one go. There's only so much wine that you can drink. So the contradictions, as the Marxists like to say, the inherent contradictions in capitalism will cause its downfall. You can certainly adapt that quote, the inherent contradictions in the EMU would seem to be leading to some type of structural change, that's a very bland way of putting it, in the EU. Yeah, the problem with the EU, what I fear is not a replacement of the dollar as a reserve currency by someone else, because there isn't anything else to replace it. What I fear is the chaos that would come about from a devalued U.S. currency, from a devalued value of the U.S. currency as a store of reserve. Because if you can't store long-term value in the dollar because the government's devaluing it, if there are structural and other impediments in Europe, if the Chinese currency is not freely traded, and in fact you can't really invest in China except for FDI anyway, if the other currencies are too small, what happens to all of that liquidity, all of that value that is looking for a place to be stored? I think we know what the answer is. The answer is alternative forms of value storage. Like what? Gold, commodities. And what happens when you have a rush and a huge pressure in these things, not because there's demand, but because the alternative methods, the alternative choices for value storage have all been degraded. This is one of the things that drove, well, not quite, but the speculation that drove your oil to $147. Why not treating commodities as value storage? I don't think it's a place that we want to go as a world economy. But it's where we might go because people will fear devaluation of their assets. Governments, individuals, corporations, everybody. And if you don't have a secure place to go, then the distortions that are induced, that are imported into, that are caused in the world economy could be very damaging. You end up with a lack of agreement, a form of chaos where everyone goes in a different direction. And that is something that I don't think we've had to deal with. And I'm not sure that the current administration seems to realize what will happen if there is not a stable currency. Think of it domestically rather than internationally. Everyone in the U.S. or any other country agrees to use the dollar. Well, what if a certain portion of the economy, of the people, didn't want to use the dollar? This happened, actually, it's fascinating, in the 30s. The Fed tightened up currencies, tightened up interest rates and reserve requirements in, I think, I'm not sure when they did it, sometime in the mid-Depression, and it caused a collapse in available currency, in the money supply in the U.S. People couldn't get dollars. So they started issuing alternative local currencies in the U.S. It's absolutely fascinating to read about it. So this is not a place the world economy really wants to go to. But if we do not reorder these problems, we'll end up there. You can't devalue the dollar and expect it still to be the reserve currency. One final note, the idea that the biggest problem in the U.S. trade balance is the value of the dollar and the Chinese manipulated yuan is not one that I ascribe to. As with the interest rates on mortgages and their effect on the home purchasing market in the United States, it's effective at the margins. It's not the base issue. The base issue is jobs and whether people will sign up for a mortgage that's going to last 25 or 30 years until they feel secure in the economy. With the trade balance, the issue is not the value of the dollar. If you look at the U.S. trade balance against any particular country and compare it to what the what the currency exchange rate is doing for that particular country, there's some correlation, but not a whole lot. The value of the dollar against the Japanese yen has been falling steadily since the early 80s. It went down, went back up, but there's a long period of U.S. decline. Has the trade balance changed very much? No. The biggest issue is the amount of saving and investment in the individual country. If the U.S. was concerned or wanted really to change that particular international statistic, it would simply encourage saving over spending in the United States. You would not have to make a large change in order for that. The quarter is still on as far as I know, yes, for that to affect the trade balance. But it's not a policy that the government has ever followed. As a matter of fact, what it's doing now and what the Fed has been doing for the past, since the financial crisis, is exactly the opposite of that. What is the incentive to save when money markets are paying 0.2 or whatever they're paying right now, where the 10-year is paying 2.5% or 3%? What incentive is there to save? There's almost none. And what is being punished? People who are actually saving money. So, on that note, I will let you all go. I thank you very much for attending. I apologize again for the late start. There is all sorts of interesting stuff going on out there these days. Keep a watch on what's going on in Europe and keep a watch on the G20. There will be a fascinating communique, I think, out of the G20 this time. Remember, this is the real G20. The other one was the meeting of the finance ministers. We're supposed to negotiate all of the positions so they can all get together for a big photo op and come out with a policy. A communique where everyone's best friends, and we all agree, and the world is moving to brighter, sunlit uplands, as Churchill might have said. I don't think we're going to get that this time, and the resistance to the U.S.'s policies is a new factor in the world economy. And, you know, if we are moving, as I believe that we are, to a new type of world financial system and a new distribution of economic power, it looks like the adjustment is not going to be all that comfortable. Anyway, I thank you all very much, and I will see you again in December. Take care, everybody.